Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we're going to make the best investments that we can, so thank you so much for joining us. And on today's show, we have Ralph Baker, also known as Shock Exchange on Seeking Alpha, and we're going to sit down and discuss some of his recent work on Valeant Phramaceuticals. If you're like me, you've heard a lot about Valeant, but may not have a strong understanding of what's actually going on at the company. After this interview, you should have a much clearer picture. We're going to talk about the bear case, we're talking about the bull case, and all kinds of details in between. So I think you will enjoy today's show, and thanks for hanging out. And we're offering a new feature to the show. If you're not able to take notes while listening, or you miss some things while you're listening to the show, and you'd like to have a summary sheet of show highlights sent to you, this is not a simple preview sheet, but actually my notes I take during the interview of all the key ideas. If you want these notes, simply text the word family notes, one word, family notes, to the number 44222, or visit investinthefamily.com and sign up, and we'll get you taken care of. Remember, our goal is to help you learn to invest financially and in all of life. You can always find more at investinthefamily.com or subscribe to the podcast at the iTunes Store and Google Play Store. How much time do you currently spend trying to figure out your investments? Are you tired of spinning your wheels, attempting to conduct research that you really don't have time for? And if we're honest, you might not actually be qualified to do. Brett Jensen is the man behind the Biotech Forum, the number 2 premium marketplace service on Seeking Alpha. He's also a top 5% ranked analyst according to TipRanks. Do you like owning companies that get acquired? So does Brett. Are you anxious about the current election season and how it may impact your portfolio? Perhaps it's time you put a portion of your portfolio on autopilot with Brett as your guide. Visit biotechforumsa.com for more information. That's biotechforumsa.com. SA as in Seeking Alpha, biotechforumsa.com. And hope you enjoyed today's interview with Ralph Baker. Well, hey, Ralph, welcome back to the show.
Thank you. Thanks for having me.
Man, well, I really enjoyed our interview last time when we just talked a lot about you as an investor, your background as an investor, the youth investing program that you've been running in your hometown with your kids and other kids in the community. And I told you before how much I respect that and how much I appreciate what you're doing there. So that was a lot of fun. But today we're going to focus on some of your more specific recent content that you've put out. And it's a little bit of a different interview. And I want to start out by some of the material you've put out about Valeant Phramaceuticals recently. Obviously, that's something that a lot of people are interested in right now. And I'll tell you, Valeant is one of those companies that I'm in no means an expert in, or even not really that knowledgeable in, which is one of the reasons I want to talk to you about it today. I want to learn about, I know some of the story. Obviously, they've had some big hits over the last year. There's a huge debate as far as, you know, what's going on in the company, the future of the company. And so I'm hoping to dive into some of that here and hear what some of your thesis are and what you're thinking. And so do you mind giving us just kind of the brief thesis of your recent article and kind of what's on your mind?
Well, I first sort of stumbled upon Valeant. I was following Gilead, and then I guess Hillary Clinton sort of started talking about sort of price gouging back in September, October of last year, and Valeant kind of got hit, and they were also on Andrew Left's radar from Citron. So I started honing in on Valeant. I was following Gilead, and I started honing in on Valeant. And what I found was that it was basically, I guess, what they were calling a hedge fund hotel. They were just going on acquiring brands and then marking up the prices after they acquired the brands. And the key for Valeant was that they didn't have the R&D horsepower that maybe Johnson & Johnson or Merck had. So they would, to protect their brands from, when they came off patent, would be through Philidor, the specialty pharma, would, through these aggressive sales practices, continue to get pharmacies to recommend their brands, even if they came off patent. So they were protecting the price. And they were going on acquiring companies and raising the price, but they didn't really have the R&D horsepower that some of the more established companies had. And then when Philidor came into question, as far as their aggressive sales practices, that sort of created overhang for the stock because Philidor represented about 60% of the company's sales.
Is it Philidor? So that's one of their prime products, right? Okay.
It was a specialty pharma that was a distributor, and they represented about 60% of their sales. So what happens if Philidor goes away? And then after the Philidor's aggressive sales practices, and I don't want to say insurance fraud because it still hasn't been proven,
Right.
But that's an allegation out there,
Right.
but still hasn't been proven yet.
It looked very questionable, I think it's probably safe to say.
Right. And so what happens when Philidor goes away? They cut ties with Philidor, and then also some of the pharmacy benefit managers said we're not going to continue to sell certain products through our network, such as Jubilee, which helped to address foot fungus. That was one of the top selling brands. So, make a long story short, their revenues in Q2 declined about 11% year over year, and they changed their strategy from one of a serial acquirer to one where they're just going to sort of focus on cash flow and pare their $30 billion of debt. The only problem is that it's an unproven strategy.
Right.
They haven't proven that they've been able to do that. And then secondly, we really don't know what the run rate revenue is or the run rate EBITDA. It's too early to tell.
So essentially, they were, and this is obviously a very negative term in my opinion, but it sounds like they're almost like a patent troll in the biotech space, where they're going around, they're buying different companies or different patents or acquiring patents, getting the products, and then you will use the phrase price gouging, like raising the prices dramatically to try to get as much money out of them as they can before the patents expire. But then once the patents did expire, they were, I'll say, probably incentivizing pharmacists or different people to continue to recommend their high-priced product, even though most likely equal quality, lower-priced generic items were available. And then when Hillary Clinton talked about price gouging, they were kind of the big poster child for that, so they took the big hits. Then you said Philidor, and you said Philidor is one of their basically distributors. Is that fair to say?
Exactly. They call it a specialty pharmacy.
Okay. And
so some of them more high priced products that were coming out patent.
Right. And so once they went away, I mean, that's 60% of your revenue's gone. And so Valeant's in a place now where if they want to survive, they basically have to become entirely new business model. And the question is, can they actually do that? Does that sound accurate?
Exactly. It's perfect. Okay. Again, Philidor represented about 6% of revenue. But also it was like they're more high priced products. So, there's an overhang with Philidor because there's some lawsuits out there. They've been sued by a group representing the NYPD, like I guess the labor union. They're saying that they were overpriced by Valeant for products that were sold through maybe through Philidor or some of the specialty products that they could have bought for cheaper. For instance, they've been sued by T. Rowe Price. Because of some of the business practices they engaged in caused the stock to decline, and they also have insider trading case involving Allergan and also involving Bill Ackman, where they've been accused of insider trading, which could cost a couple $100 million as well. So the point is,
and this is Philidor or this is Valeant?
Valeant, Valeant, yeah, Valeant, but Valeant's been sued pursuant to Philidor.
Right.
Some of their business practices, which again, some have said is insurance fraud. It hasn't been proven, but at a minimum, we know that once Philidor went away, the sales declined and the stock fell dramatically.
And so, what's the concern with Bill Ackman? What's the accusation that he's done?
That pursuant to their deal with Allergan, they traded in. I think an Allergan stock that could have been considered insider trading. So Allergan's accused them of insider trading.
Okay.
And I think the case is pending, but they profited from Bill Ackman profited. I think he shared some of the profits with Valeant, and I think it's in the press. Press has been about maybe $390 million in earnings that they gained. Wow. So that case is out there. So they have a few legal cases out there. And my point is that they got maybe $800 million in cash and $30 billion in debt, and they need to pay debt. But two things: they're keeping their legal team busy and probably outside counsel, which is running up fees at a minimum. And secondly, if one or two of these lawsuits hits, it could cost them a couple $100 million, which I think throws a monkey wrench in their cash flow management and their debt paredown, thesis, which is their new strategy.
Let's talk about that debt paredown thesis. When you've got $800 million in cash, $30 billion in debt, how do you have an effective paredown strategy when you're leveraged over 30 to 1? I mean, obviously there's assets I'm sure involved that they can factor in a little bit. Is that all based on hopes and future revenue growth, or what are they trying to do?
Well, the sort of it's not necessarily logical, but when you look at these companies, when they slow down, when their revenue slows down, they're actually cash flow generating machines. So when a company is growing, they're using cash flow. They use a working capital because they're growing accounts receivable. They're growing inventory faster than they're growing their payables. And when they slow down, it should be the opposite. They should be collecting on receivables and collecting on and paying down and collecting on inventory and paying down payables and pocketing the difference. So if the company slows, it should be a cash flow generating machine. However, we don't know their true cash flow. And secondly, their debt to EBITDA is about 7 times. It's over 7 times, which is highly leveraged.
Right.
So, as this business slows, can it generate the cash flow that it should be generating?
And when you say business slowing, because again, when I hear that initially, you think revenue is declining, which hurts cash flow. But I guess the idea is if the business is slowing, there's not as much reinvestment of capital. Is that the idea?
Exactly, and they're cutting capex, and they really don't. And then R&D wasn't really strong to begin with, but their revenue, Q2 revenue, fell about 11% year over year.
Of course, Q2 revenue falling 11%. If you just lost 60% of your sales through Philidor, that actually doesn't sound too bad. But I guess a year ago this time. I guess it hasn't been a full year. It's almost been a year now since the Hillary Clinton price gouging comment when all this hit. So that actually doesn't sound too bad. And if you look at it in that perspective, maybe I'm missing something.
No, it's 6%. 6.
Oh, okay. Okay, nice.
6.1%. But their revenue did fall like 11%. And for instance, dermatology sales fell like 55%. That was the segment that included Jubila, which is a big seller through Philidor.
Gotcha.
So as revenue declines, the revenue and EBITDA is declining. However, their working capital, it should be shrinking working capital. So if they have positive working capital, it should be monetizing that difference between their short-term assets and short-term liabilities. But we'll see how that works. This is from my old lending days. But this is how this should work, and we'll see if it works next quarter. But again, the risk to that thesis is rising legal costs. They're constantly being sued. Legal costs from internal and outside counsel, and if one of those lawsuits hits, it's a big. It's going to hurt their cash flow immensely.
So, how much? Okay, so the revenues were down by 11%. So, for example, what were their over the last 12 months or the last annual report or whatever else? Like, what were annual revenues? I'm curious because again, if this strategy, they still have $30 billion in debt. I'm curious what revenues were in terms of how realistic it is for them to even be able to pay that down in any meaningful period of time.
I have to look at the annual sales.
Maybe do you know what they were in Q2, just roughly?
I don't have it in front of me.
Okay, that's fine.
But I know that they were down by 11% year over year. And again, I didn't really focus necessarily on. I'm focusing more on cash flow at this point.
Right.
So that's the biggest determinant of whether this company survives. Can it generate enough cash flow to pay debt?
Tell me about that.
Theoretically, it could. But I'm not. We just don't know yet.
Sure. What are they saying? Like, what are their hopes in terms of like cash flow production to be able to make a dent in that $30 billion?
They're very. They're just very high level. They're hard to pin down. Yeah. They couldn't even put together a quarterly report.
Right.
It took them weeks to put together a quarterly report, and it took them weeks to tell you whether Philidor existed and their relationship with Philidor. They just couldn't. They never really answered a lot of questions. So again, I think everything is sort of a question mark. I think theoretically they could pair debt. And with $30 billion in debt out there, their lenders really have no incentive for them not to survive. The lenders want them to survive to pair debt. The question is, what is the equity worth? That's the question. So if they were to pair debt, what's left for the equity holders? And I value the company based on look at around 8 times run rate EBITDA. I valued the company around $10 to $11 per share.
Wow. And it's in the 20s or 30s now? I forget.
Yeah, high 20s, early 30s, low 30s. But nobody's really doing this type of fundamental analysis.
Yeah, well, I mean, it's again, there are several companies, and obviously you and I work a lot within Seeking Alpha, not exclusively there, but a lot of our work is there. And there are several companies that obviously, for good reason, in most cases, get a lot of attention. You get your Teslas, your Apple, your Gilead, and Valeant. And so, there's a lot of content created around those. And so it's sometimes the hype around things can overshadow the fundamentals, but that's one of the reasons I like having you on the show, because you focus there very heavily, and I appreciate that.
Well, that type of hype has been rewarded, though, because they've been acquiring companies and growing revenues, and in this type of environment, that type of hype has been rewarded. So it's kind of hard to argue with something that's been working for 5 or 6 years. But I think now, as the economy slows and people are starting to focus on maybe a potential rate hike or even the Fed not even supporting the markets anymore, I think it's time to do that type of fundamental research. And again, Valeant is more of a question mark because we really don't know the true revenue or the true cash flow generating ability. And they're hard to pin down. They really don't give a lot of
which is not a good sign.
And when they do, they change it a lot. But back to your previous point, Q2 revenue is around $2.4 billion.
Okay. So they've got, okay. Yeah, so they're bringing in a tremendous amount of money. Can they manage cost and get cash out of that? Because if you're bringing in $2 billion in a quarter, that, and you keep your costs meaningful, then that $30 billion is still huge, but it's not quite as intimidating.
Well, again, they're losing some sales through certain pharmacy benefit managers, and they've also cut prices on some of their heart drugs in response to an inquiry from Congress. So again, it's really too early to tell what their true revenue, EBITDA, and cash flow generating ability is. And I think it's sort of interesting that they're talking about pairing assets while there's still a question mark over what these companies' true revenue and cash flow generating ability is. So a buyer will have to sort of make those type of assessments.
Right. I want to talk through, you gave a price target of around, I think you said around $11 or so. I like to hear more behind the scenes how you arrived at that number. You mentioned a few of it, but I want to hear it again and make sure I'm missing it.
Right. I looked at it. I'm going to put a valuation article in maybe a couple of days, but I looked at it at a high level, and basically I took the run rate EBITDA, where I thought the EBITDA would be for the next couple of quarters at 8 times EBITDA, and subtracted the debt around $30 billion. And I came to $10 to $11 per share. I did a valuation back in Q3 of last year and came to a price of like $35 per share, just based on 8 times EBITDA. And I chose that because it's in the pharmaceutical space, but the revenue and EBITDA aren't necessarily growing. So I thought 8 times felt about right. And people thought I was crazy. And the price was around $75 per share. And now it's around $30 per share.
And now you're looking at really valued closer to 11.
Right, because revenue and EBITDA are declining. If you look at the bottoms up, what their run rate EBITDA is at 8 times, and subtracting that huge amount of debt, that's what the market's not really focusing on.
And so did you get that EBITDA, did you get that number from from their numbers, or is that a number you calculate? Okay. So straight from their Q2.
Yeah, Q2. I think I took just looking at it at a high level with Q2 and Q1, and just said this is probably what they can generate on a run rate basis. And I added a little bit of optimism because we know that number's declining. Mm-hmm. But I'll put the article out in the next few days. But I came up with a price around $10 to $11 per share. But you also have to subtract the net debt.
Right.
You do the enterprise value, subtract the the debt minus the cash, and you come up with the difference, the equity value.
Yeah, I'm eager to see what kind of attention that article gets, because I'm sure there are a lot of people who have a differing opinion. So in the articles you have written, have you learned, like, from the comments, what have you learned and gained from there? Because I'm sure there's some pretty vocal people on both sides of the equation. Have you learned much from that, or have you seen much of value there?
Not necessarily from the Valeant articles, just a lot of emotion on both sides.
Sure.
And that people say, well, you're a short seller, so we can dismiss you. But but when you start to peel back I put the numbers out there. I put the revenue, the EBITDA, and my valuation methodology out there. And the key, the point of it is to if you don't agree with, you have to agree with some baseline facts. This is the revenue. This is the run rate EBITDA. Now, what multiple you put on that is up to you. Sure. But I think 8 times feels right for a company whose revenue and EBITDA are in decline. And that builds on a certain level of optimism. But when you look at that $32 billion worth of debt, that's a huge number, and that has a big impact on its equity value. And
go ahead. Sorry.
Go ahead. I didn't mean to cut you off.
No. So what? So you put an 8x value on there. What would a industry comp be for that?
I didn't necessarily look at industry comps because to me this isn't necessarily
it doesn't fit.
It's not really a pharmaceutical play because it's just a serial acquirer. It doesn't really invest in R&D. Mm-hmm. And it's just a serial acquirer, and its ability to acquire these companies and raise prices is how it differentiates itself. So it's hard to compare it to a Merck or a Johnson & Johnson. So,
obviously a lot of what we're hearing today is definitely painting a pretty convincing bear case for Valeant. What's the bull case? Because obviously there are a lot of people who are very pro the company. What's their argument?
I think from the comments that they're going to sell these assets and they're going to pay our debt, and that they believe in the new CEO, because they feel like these assets have value. They don't know how much value it has because they haven't done any fundamental analysis. But the other thing is that when you have analysts putting price targets on these companies, that also has a big that also carries a lot of weight with the crowd, because Ralph Baker in a cubicle somewhere saying it's worth 11, and then you got 10 analysts. If we have enough analysts saying it's worth 40 or 50 or 60, that's going to be the price in this environment, this low interest rate environment. That analysts can move markets just based on what they say. I think there was one analyst that had an $11 price target as well. So whatever she did must have been exactly what I did.
But most analyst price targets sound like they're pretty bullish.
Right, and they've been. If you were analysts over the past 6 or 7 years and you weren't bullish, then you're probably out of a job. I mean, because that the bull case has been working, and this low interest rate environment where people put a lot of value on momentum, Valeant has delivered the momentum through acquisitions, and they've been rewarded. So if you listen to me over the past 5 or 6 years, you probably haven't made a lot of money, but I think people are starting to listen now because Valeant's business model has come under scrutiny. And again, people are starting to come to the realization that the economy is slowing, and the Fed may not be there to provide a floor for these stocks anymore.
So when you look out into the future of Valeant, do you think, this is a hard question to answer, but do you thinking, if they don't have significant change in 6 months or a year, then they're done? Or is there a time frame in your mind where you feel like they've got to turn the corner? Or is it all just a big, huge fog mess right now?
I think in my heart of hearts, I think they can survive. The company can survive for several more quarters, but the equity will be worthless.
Gotcha.
The equities, because they have, if you owe somebody, if you owe somebody a little amount of money, the lenders own you. If you owe them a lot of money, you own them. And they owe lenders a lot of money, and the lenders have every incentive to keep them around. You follow?
Mm-hmm, I do.
To help pay that debt. However, if you look at, again, the cash flow generating ability, I don't trust whatever management says. They don't have a strong track record, and it's a question mark. I have to look at what happens next quarter and the quarter after that. And then secondly, with these asset sales, does a buyer want to take on, you can't take on certain stock risk because you can't buy the stock of these assets because it may come attached with certain legal risk from these lawsuits. So they may want to structure these assets as asset sales, these deals as asset sales, or may try to attach some of the risk to these assets by lowering the purchase price. So it's not a great time to sell assets, I don't think, for Valeant because of all the legal risks around the company that a buyer may feel like they have to take on. So I think that's another hindrance to their thesis. So I guess in my heart of hearts, I think they can survive, but the equity could be worthless. The lenders will keep them around long enough. They keep adjusting covenants and helping the company stay around long enough to get their debt repaid. But what's left for the equity, I have no idea.
Sure. Well, it definitely sounds like they've for sure got their hands cut out for them. And Ralph, I really appreciate the time you spent today because, like I said, Valeant is not a company I've spent a tremendous amount of time with in the past, but I know it gets a lot of attention. And I think you've done an excellent job of walking through how they've gotten to where they are. And obviously some people have different opinion, but I think, you painted a very strong case in terms of the bear perspective. It would also help us understand why so many are still bullish on the company as well. So thanks so much for your time today, and I appreciate you joining us.
Thank you.
Well, I hope you enjoyed today's interview with Ralph Baker. Remember, you can get full show notes with links and other details at investinthefamily.com. And don't forget to subscribe to us at iTunes, Stitcher, or the Google Play Store. And if you want to receive my summary sheet highlight notes from this show, simply text the word family notes, one word, family notes, to the number 44222, or visit investinthefamily.com and sign up, and we'll make sure to get you set up with all those notes. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.